All right, let's just jump into these investment strategies real quickly. A core strategy. And by the way, these are increasing in risk and increasing in return as we kind of move this way. So it's riskier. Goodness, how am I going to write that? It's riskier as we're moving that direction. So the core strategy is buying well leased, well located buildings. Typically, that's going to be the Class A stuff. And they're going to have stable tenants, stable credit, high credit tenants, and long term leases, so very stable cash flows. So a good tenant mix, good tenant base, and not a whole lot of risk. The cash flows are stable, relatively low risk. Returns would be relatively lower for this strategy because it's safe, right? So lower risk should lead to lower expected returns. A core plus strategy is going to be similar, except that we're going to buy some buildings that might need some level of capital expenditures, and that would be needed to spruce up the property and help improve or increase the rental rates. So these might be B or B plus buildings, so not quite the A, but could be turned into A with a little bit of love and a little bit of money. A value add strategy, on the other hand, these are properties that definitely have some issues. These might be, definitely B properties, maybe older properties, not necessarily been well managed. Maybe there's some neglect. These are going to definitely involve more significant renovation, more significant capital expenditures, and a significant marketing campaign to help bring up the occupancy. The cash flows for these have probably been suffering somewhat, and the dream is by adding some capital, we improve it, and we can improve occupancy and dramatically improve the cash flows. And then lastly, the most risky of these strategies is the opportunistic investing strategy. So this is where we're buying properties that are distressed. They're going to have very high vacancy rates, could be even empty, and they're in need of significant renovation or redevelopment. These properties are usually going to be selling at deep discounts. Sometimes, I put this little comment, sometimes referred to as per pound. So when you're buying, or if you're buying real estate, 300,000 square feet and you're only paying $8 a square foot or $10 a square foot, you're getting this really big property for $3 million. It almost isn't selling, or it's not really selling based on the cash flow it produces, but just based on how big it is and what it could do. So that's going to be opportunistic investing. When you're paying a really low amount per square foot, that would be kind of a per pound basis. Now, again, this is risky because it's going to entail significant money to put into the building and kind of reposition it, change it up, or completely redevelop it in the marketplace. And but once you do that, because you bought it at such a discount, and if you kind of execute your strategy right, you can get some very high returns based on the value that you add to the property. So opportunistic investing is the most risky, should have the highest expected return because of the risk you're taking on as an investor. All right, let's move on here and talk about kind of the heart of Chapter 11, and that is projecting cash flows and building up the pro forma. So we've talked a tad bit about this, I think, in the past videos, in past discussions, but a pro forma is a forward-looking projection of the cash flows for a property. We might be doing a 3, 5, or 10-year pro forma. It all kind of depends on our investment horizon. And as we build a pro forma, and we're actually going to walk through this in painstaking detail, we're going to consider 4 kinds of cash flows. So I've put these into 4 buckets. I like buckets. They're kind of self-contained vehicles that hold stuff that's kind of alike, or at least once it's within a bucket, it starts to kind of become homogenized. So we're going to treat these as 4 different kinds of buckets with 4 different kinds of cash flows. And in terms of the kinds of buckets, we got a transaction bucket, which is going to have the cash flows from buying and selling the property. We're going to have the property bucket. That's going to capture all of the operations and the capital cash flows from the property itself. So just how it runs, what its cash flows are, what cash flows it's generating, what cash flows it's requiring as we run the property. Then we have the financing bucket. This is going to be all of the loan stuff that we have, all of the loan cash flows that are involved with our purchase. Now, we don't have to have the financing bucket. We could pay all cash, but most investors typically will bring in outside money. And that could come from loan proceeds. Later on in the next chapter, actually, we'll talk about alternative sources of capital and financing. So it doesn't just have to be a big bank that's making a loan. We could get a bank loan and then get mezzanine financing to kind of juice up our returns. So financing bucket though, loan proceeds, any loan proceeds that we get whenever we make payments along the way. So we got the proceeds at the beginning, the payments that we make along the way, and then at the end, of course, if we've got a loan and we sell the property, we have to pay off our loan. So whatever is outstanding at that time. And then finally, we need to talk about taxation. So we have a tax bucket. We're going to need to determine the taxes on our operations and when we sell the property. So for a minute, we're going to assume that we're not going to deal with a 1031 exchange. And when it comes time to sell the property, we're going to incur taxes at the disposition. So we will go through each of these buckets in detail. And so let's jump into the first bucket, which, in many ways should be pretty simple. This is just the transaction cash flows. When we buy the property, that's one transaction. When we sell the property, that's the other transaction. So again, very simple. Think about this on a big picture level. Get up to 30,000 square feet, look at what we're doing, and try to fit all of these pieces together. It's very logical if you will kind of think about it, take a few minutes to digest it, think about how it fits. It would not be all that hard to recreate this. If you just will think through this process, think through these buckets and how they fit together. So back to the purchase. How much do we have to pay for the property? And we want to include any closing costs as well. So the purchase, all the cash flow that we have to spend to buy the property. All right, that's it. Purchase. Disposition, that's a fancy way of saying sell. The disposition cash flows, we want to think about how much cash is coming from the property when we sell it. We're going to have to pay off our loan from these proceeds, these sales proceeds. And if we have money left over, hopefully we will, that would go to the investor. Now, there's two things that we're going to have to consider, and this after-tax cash flow right here, this at the bottom, we're really going to kind of sneak that into our taxation bucket. So for now, we're going to consider just the before-tax cash flow from sale. And so that means we have no tax effects that we're considering. We only are looking at how much our proceeds are once we pay our selling costs. And then we would also look at paying off our lending cash flows. Actually, we're going to stick that loan in the financing bucket. So here in the transaction bucket, it's just how much do we sell this property for, and we'll take away any selling costs that we have, right? Any commissions or other things that we have to incur to sell the property. So here's an example, and we're actually going to work through a very detailed example. So let's just start talking about this example with our purchase and sale. For the example we're going to buy a property, and we can maybe think about it as a fourplex. It doesn't necessarily matter as long as it is going to be a residential rental property, because we're going to depreciate it based on a residential setting. So this is not a commercial property. That means it's not 5 units or bigger. So somewhere between 1 and 4 units, we can think of this as maybe a fourplex. So we're buying it for $575,000. We also have 1.5% in closing costs that we're having to pay, so an additional $8,625. So our gross purchase price is the sum of those things. We're out of pocket, and this would be a big negative cash flow, right? We're out of pocket $583,625. That is our purchase price. That's the very first cash flow that we have to consider. It's a very important one, right? It's a huge one. And so we're going to make sure that that's part of our analysis. Secondly, in our transaction bucket is how much we're selling this thing for. And so we're going to assume that we're selling this thing for $823,261. Now that's maybe a bit too particular. Most sellers are going to be rounding to the nearest 100 or the nearest 1,000 or even the nearest $10,000. But we're just going to stick it, we're going to let the model kind of tell us everything right now. And we're going to sell it for that amount. Now, where in the world is that number coming from? Well, it's based on a 3.5% annual appreciation rate over a 10-year period. And we could also look at this based on an exit cap rate. So we could look at this and see that we're selling it on a 7.31 cap based on year 11 NOI. And so as we build out this pro forma, we'll see these numbers and you'll understand kind of where they came from. Now, from the gross price of $823,261, we're going to have to pay 7.5% in selling costs. So those are some transaction costs that we incur as we sell the property. And so our net proceeds, basically 92.5% of our gross proceeds, our net proceeds are $761,516. And already you can start to see some things taking shape here. We've got this, this difference. Let me get a new pen here. We've got a difference between what we bought and what we're selling the property for. So that should tell you that we got some gains here. They're going to incur some taxes at the end. So, and we got some profit. So we got a positive return on our investment. That's a good thing. We got some taxes to already start thinking about. But this is the transaction cash flows, the buying and the selling. So let's jump into the spreadsheet and we're going to kind of build this along the way. So let me give you quick the kind of overarching view. Then we'll go to Excel in this video and build this thing out. So on the left side of this spreadsheet, this table here is, let me go back to my red. These are all the assumptions that are driving my my pro forma. It's always a good idea, anytime you're building a spreadsheet, anytime you're building a pro forma, to have an area that has all of the pertinent assumptions that drives the results of your analysis. So everything that we need is over there on the left. Almost everything we need. We're going to add a little bit more later, maybe a couple of lines. But right now, that stuff in yellow captures all of the pertinent and important assumptions that drive our analysis. So over here, you can see our purchase. That transaction cash flow, it's happening at time period 0. We're out of pocket $583,000. And then in year 10, we're selling it, and we're selling it for a gross price of $823,000. We have selling costs of $61,000. And so if we netted those two together, that would be our net proceeds. So let's go to Excel here and take a look at just building this step by step. Okay, let's fill in this spreadsheet, and we're going to do that based on our assumptions. So the purchase price is going to be equal to a negative cash flow. We're going to link over here to our purchase price, and we're also going to subtract out the closing costs that we have to pay. And so our purchase price is really just the sum of those two numbers. So we're out of pocket $583,625. That is our gross purchase price. Now our selling price, for now, we're going to look at it in one way. Later on, we'll look at it in a separate way. But right now, we're just going to look at this property appreciating at a rate that's given down here. We got this price appreciation of 3.5% per year. And so I'm just going to create a quick little formula here and say our sales price is going to be equal to $575,000. That's the value of the property. We're going to multiply that times 1 plus the appreciation rate, for that, and then raise that to the 10th power because we're doing this. That growth is compounding for 10 years. I could also use the future value function. Sorry, I'm not doing that. I'm using a formula, but you get the same thing if you said, what is the future value of $575,000 grown at 3.5% for 10 years? That would give you the exact same number. Why am I growing 575 and not 583? Well, the value of the property really is $575. It just so happens that I paid some additional costs. So those additional costs really aren't adding value to the property per se. It just allows me to do the purchase. So in any event, my sales price is, it looks like it's a little bit different than what we had in the PowerPoint. Hold on. Okay, so I see why there's a discrepancy, and it's actually kind of a little funny. The number that we have in the PowerPoint is not tied to the 575; it was tied to the 583. And so in the PowerPoint, I assumed that our closing costs were kind of bundled into the purchase price, and that would add value and that would grow over time. I think what we have here is better, 811,094. I think this is more representative of what the numbers would be. So I might tweak the PowerPoint going forward. But our value at the end is going to be $811,094. And then in terms of continuing to build out the pro forma, we're going to have some disposition costs. And when we sell, that's down here. So, oops, not times that. No, that's right. So we're going to enter that in, and we got $60,830 in closing costs. So that is the transaction costs. I'm going to go ahead and fix the PowerPoint so actually it might look corrected by the time you see it. And we'll continue on with the next video looking at the property level cash flows. So I'm going to go ahead and stop there, and we'll see you in the next video. Bye.